Guys, PayPal just reported they absolutely crushed it. Let's check out the stock right now because it is up and it's up big. 10.5%. It's actually down a little bit from its peak here. Guys, I own PayPal. If you're new to this channel, what I'm going to say next to you is very important. Never, ever, ever buy a company because somebody on the internet has it. I'm here to teach a process. I'm here to talk about the reasons why I own PayPal. There are thousands of reasons probably not to own PayPal. We're here to teach a process. PayPal hit an all-time high of 310 back in July of 2021, and it got as low as like $50-something a share as of late. But here's what they reported. Their revenue came in at $8.42 billion versus 8.28 estimate, and their earnings per share $1.34 versus $1.20 estimate. Guys, this is a company that everybody thought was dead. They're back to growing still even more. And it's actually the number one owned stock by our community members. Doesn't mean it's the largest volume amount of money, but it's in terms of an individual company, this is owned the most by our community members based on our data and their self-reporting. Again, doesn't mean that you should own it for that reason. But if you're in our community, if you have our software, and you don't know if you want to own PayPal or not, have a conversation in here because that's really important. That's the reason we created this community so that people could chat about it. Now, let's go take a look at PayPal here and what they reported. So first off, here's why they're surging also. PayPal stock surges on earnings beat and OpenAI partnership. Guys, that's a big one these days. Is it going to amount to much? I don't know. I will tell you that OpenAI and PayPal are working together so that people can buy stuff on OpenAI through PayPal. That is going to help their transactions incredibly. This is a business that makes money off of more transactions. We'll get to that shortly. But in addition, guys, PayPal also announced a dividend. Now, it's a 14-cent dividend. And they also raised their full-year adjusted earnings guidance from $5.35 to a range of $5.35 to $5.95. People love dividends. But here's what I'm going to say about dividends for a company like this. This is a company that's currently selling for 14 times free cash flow, 16 times earnings with back to growth mode. Maybe they should be using their money to buy back shares. That's my opinion of it. Dividends are what you pay when you have nothing better to do with the money. I love what Costco does. They do one-off dividends. They accumulate money for years and they go, hey, we're going to pay $30 per share one time. Boom. Everybody gets excited, but they don't commit themselves to a long-term dividend. Yes, I get it. People love a long-term dividend. But for me, and I love dividends too, but I want it to be the last resort of the money. Okay, now the stock is currently at $78 per share after being up right now 10.5%. In our community, the average intrinsic value is 92%. If you're new to the channel, intrinsic value is basically what our community members think the stock is actually should be valued at, okay? I think my number is a little bit higher. I'll get into that shortly on the stock analyzer tool, but it's important to remember these things. Okay, so let's go look at their actual earnings released also, because I want to sit there and break this down. Revenues increased 7% to $8.4 billion. Transaction margin dollars increased 6% to $3.9 billion. GAAP operating income increased 9%. GAAP operating margin increased 33 basis points. GAAP EPS increased 32%. Does this sound like a company that's declining? Guys, I always said my thesis on PayPal was they might have less users, but they're getting more money per user, and it's trusted. When I'm buying something overseas or something that I want, I go to PayPal because I know they're going to have my back. That's what's really important to me. Several of my businesses, I use PayPal in order to collect money from people, and I'm the vendor of it. It's really, really important for me to have that protection. That's what I have with PayPal. Guys, this is a big week for this channel. A lot of earnings results. We're going to have big companies, Amazon, Google, Microsoft, all these big companies reporting this week. In addition, we're also having a record month in terms of views, and we're growing like crazy. If you're interested in being in listening to a channel that goes over earnings results, that goes over news in the market, that just does 20 or 30 videos a month recapping what's going on. We have the Fed rate decision tomorrow. We're going to make a video on. Follow the channel, subscribe to the channel. It's really important to do that. That way you stay up on it and make sure you're notified when these videos come out. Okay, cash flow from operations was $2 billion. And free cash flow is 1.7, which means their capital expenditures were $300 million. Adjusted free cash flow, $2.3 billion, which excludes the net timing impact between originating buy now, pay later receivables, blah, 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 blah. Okay. Cash and cash equivalents and investments, $14.4 billion. Debt was $11.4. Guys, now payment transactions decreased 5% to $6.3 billion. If you exclude payment service provider transactions, which is, vendors like using them as a services, payment transactions increased 7%, which means that users are using it more than vendors are using it. Is that a good thing or a bad thing? I don't really like that very much, but we'll see what they're going to do in the future to account for that. Guys, look at all these positives. The only negative here, the tax rate basically went down. That's the negative in all these numbers here. Yeah, the operating margin decreased slightly. Effective tax rate was what went down, which is incredible. Free cash flow up 19%, adjusted free cash flow up 48%. That is the lifeblood of the business. Earnings per share up 12%. Some other things I like about this company also, guys, look at this. Gross profit is 47%. This means that every extra dollar, every extra transaction they do, 47 cents of that goes to the bottom line. Hopefully that'll allow them to increase their profit margin. As you can tell, their 5-year profit and their 1-year profit are very, very similar. But here's another thing I love. Their free cash flow in the last 5 years and last year is higher than their net income in the last 5 years and last year. It's hard to find that. Adobe's a company that has that too. Most people focus on the net income. We focus on the free cash flow, and it's higher than their net income. That is a positive sign there. They did $1.7 billion in free cash flow last quarter. If you multiply that by 4, how much is that? 4, 2.8, $6.8 billion in free cash flow, which is much higher than last year's. Now, I don't know how their seasonality works for numbers and things like that, but as we saw here, their free cash flow is up 19%. And if you actually do 19% on 5 point whatever billion, it gets pretty freaking close to $6.8 billion. So this is a company that is, and they even say in the first line, is it the first line? No. Right here, this is a stronger company today than we were 2 years ago. I love how simple that statement is. It's such a simple statement, but they're saying, listen, we are a better company now than we were 2 years ago. This makes investing difficult. PayPal is a company that had to figure things out. There was a lot of competition in the fintech space. I think they've done a good job of turning things around and making sure that their positive name and their reputation help them turn things around. Okay, so now let's go see what analyst estimates are. First of all, let's go look at the 8 pillars. It's an 8-pillar thriller. Remember, just because there's all 8 check marks doesn't mean you buy the company. It's telling a story here. They have bought back a lot of shares. Hopefully those are on the cheap side because in the last 5 years, they were very expensive. 5-year PE, 5-year price to free cash flow, high returns on capital, getting better. Because look, their 5-year return on capital is 10.6%. Last year was 12.8%. It is getting better. This means as time goes on, they're getting a better return on the money that's invested in the business. That's really, really good. Low debt levels, revenue growth, net income growth, cash flow growth. Everything's a check. Let's see what analysts think about the company. They have earnings per share going from $5.35 this year to $8.43 in 3 or 4 years. A lot of growth. Pardon me 1 second. And then for revenue growth, we have $33.7 billion to $42.4 billion. Not much revenue growth here, but they're showing better numbers. These might get adjusted higher. We don't know exactly, guys. This is something to pay attention to. Now, with all of this, it leads us to one question. What is the right price to pay for PayPal? Well, remember, guys, the story is starting to get a lot better. But if we pay too much for the story, you end up with a bad investment. That's really, really, really important to understand. It's the fifth pillar of our principle-driven investing. And guys, after we're done with the stock analyzer tool, I'm going to go over UPS because they just reported and they're up 6 or 7% right now. So I want to go over that quick. Remember, we're putting the story and the numbers together in our stock analyzer tool. This is the most important part of my process. I don't know about your process, but for me, when I first see a company, I immediately go do a quick overview, and then I go to the stock analyzer tool. And the reason being is I want to see, is it even worth my time? Because PayPal is currently selling for $77 a share. Let's say I do all of this, and it tells me PayPal is worth $10. Well, why waste any more time? I don't want to waste any more time on PayPal. Let's say PayPal is worth 100 according to my numbers. Okay, it's selling for a nice discount. I need to go spend more time. And then once I do my research, I come in here and tighten up my numbers and I figure out the right price for me to pay, the intrinsic value. That's really important. That sounds like it makes sense to you. If you've watched enough of our videos to realize how powerful this software, this community is, not just in terms of the tools, but also in terms of being around like-minded people so that when we do have a bear market, I know it doesn't seem possible, you can be by the right people who will help you get through it and profit from it. If that's of interest to you, click the link below. We have a 7-day trial on our software. It's not for everyone. It's just for the right people. It's very important. If you're a person who believes in learning and getting better, this is the community for you. If you're the kind of person who wants to level up your investing game, this is the place for you. So check it out in our community. And again, if this is your first time watching the channel, don't go to it yet. I want you to see that we think differently, that we're different than all the other YouTubers out there in terms of our process. We talk about things that people don't talk about out there on YouTube. So I did a 10-year analysis. Now, guys, I'm going to modify this a little bit. I'm going to go with 5, 7, and 9% revenue growth because they're back to growing now. Profit margin, I did 13, 14.5, and 16. And for free cash flow, it was higher. I put 16, 19, and 22. And the reason I put 19 is in the last 10 years, it's been 19 at average. It is declining here, so I wonder about that. But we had a big surge. We just saw a 19% increase. We hope that's permanent. Now, the PE and price of free cash flow. At the end of year 10, at the end of this analysis, what's the right PE and price of free cash flow to assign to this company? Well, guys, the historical average is 15 or 16. For good businesses with high and increasing returns on capital and that have good growth rate, you go higher. For bad businesses, you go lower. So I put 16, 19, and 22. Now, I don't know what the right number is, but I'm just sitting there saying, let me just start with that, 16, 19, and 22, and finally my desired return of 9%. Now, that 9% doesn't mean this is the price I'm paying for it. It just means what's my intrinsic value? What's the market return value? But I need a margin of safety. I need to buy it for less than that. Now I'm going to hit the Analyze button. Again, just wait around for UPS here. But I hit the Analyze button. The stock's currently at 77. This is why I have PayPal. I have a low price of 80 to 100 based on free cash flow. It's at 100 and a high price of 165 to 225, a middle assumption of 115 to 150. And based on a discounted cash flow model, if I bought this today, I'm looking at 18.5% return if my middle assumptions occur. So I think this is worth more investigation if you believe these numbers above. I own the stock. I don't know what my position size is. I don't look at my portfolio ever. I just buy when it makes sense, and it seems to make sense to me. But again, don't follow that. Now, UPS. UPS reported they beat on revenue, $21.4 billion versus estimated of $20.84. They crushed on earnings per share, $1.74 versus $1.31 estimate. They beat by 33%. Let's pull up the stock right now. UPS is up 7.7% currently. Wowza. Decent returns on good returns on capital, 5-year average of 16.8%. A lot of debt. Our group has an intrinsic value of 94 with an average hold price. Profit margin, 8.1% in the last 5 years, 6.3% last year. Gross margin, only 18%. Free cash flow, $3.5 billion versus 5.7. Let me pull up their earnings release because I want to sit there and see what they're saying in their earnings release. Earnings release. I want to sit there and understand what exactly is going on here. Let's go to the PDF. Earnings release PDF. Let's make this bigger for everybody to see. Today announced consolidated operating profit was $1.8 billion. Let's go to the chart to see it compared to the previous year. Okay. Revenue declined from $14.6 billion down to $14.2. Operating profit declined from $843 million to $603. Okay. Even on the non-GAAP method, it was declining. Okay. International segment versus supply chain solutions. Let's see what else we got. Outlook. The company provides certain guidance for the fourth quarter. UPS expects revenue to be approximately $24 billion. Remember, the fourth quarter is the busiest time. Let's see what they did last year in the fourth quarter. So we're going to go here, income statement, do it by quarters. Last year, $25.3 billion. So still a decline. Still a decline. Now remember, guys, a declining business still worth something. Let's see. But here's the issue I have. Why would you pay 23 times free cash flow on a declining business when you can buy PayPal for 15 times free cash flow? Now, they could be turning things around. I'm sure UPS can be around for a very long time. But it's not like it's a screaming deal. PayPal got to like single digits free cash flow. And I'm like, okay, that seems to make sense for a company that's turning itself around that has a lot of potential. UPS has a great reputation. But I look at this thinking, it's feeling kind of icky in that regard. Let's see what analysts think. Well, analysts think their revenue, their profit's going to increase 660 to 1081 in the next 4 or 5 years. And revenue will decline, be flat, and then start to grow again. Makes sense. Makes sense. So let's pull up our stock analyzer here because I really want to see if it's worth my time any further. So guys, I did a 10-year analysis. I did 2%, 4%, and 6% revenue growth. I want to make note, declining returns on capital here. 10-year average, 20.6, 5-year average, 16.8, last year, 12.8. Profit margin, I did 7.5, 8.5, 9.5. That might be aggressive because look at their 10-year average is 7.5. Let's do 6, 7, and 8. 6, I'm going to keep 5, 6, and 7 for free cash flow. Now for PE, it's still a good brand, still well known. It's one of the top 2 providers out there, but it is declining. So I'm going to go 13, 16, and 19. And I'm going to do my 9% desired return. The stock's currently at $96 a share. All right, not awful. We have a low price of 70 to 85, a high price of 165 to 190, and a middle price of 110 to 130. The discount at 10.8% return includes their dividend, and I believe they have a healthy dividend. Their dividend is 7.3%, and that's going to get cut. You know why? It cost them $5.4 billion per year. They're not even generating that in free cash flow. I got to think that's going to get cut at some point. So guys, again, if you like this channel, if you like what we're talking about, subscribe to the channel. If you've watched us several times and you're ready to make the next step to really level up your investing game and be around more people like you, click the link below. Check out our 7-day trial. I assure you, you'll be like the other 83% of people who sign up for the year once they do the free trial. Thank you for your time.